Applied Corporate Finance Unit 4, and in this particular video we're going to talk about the trade-off around debt. So what are the pros and cons of having debt in the capital structure of the firm, right? Should a firm have debt, as we asked in the last section, as to whether it makes sense for a firm to have debt or it does not make sense for the firm to have debt. There are companies like Infosys, HUL, etc. that have zero debt. And then there are some companies who have a lot of debt, like the likes of GMR Infra, the likes of JP Associates. So how much of the debt is too much of debt? And what are the pros and cons? What are the positives and negatives that come along with having a lot of debt on the company's books is what we are going to discuss. What are the reasons why a company might want to raise debt? And what are the reasons why a company might want to avoid raising debt is what is the broad construct of this, right? So that's what we're going to look at here. So let's just outline broadly what kind of key benefits and lower, key costs are there. We have already seen some of this earlier, which is debt is cheaper. Debt gives tax benefits. Debt gives an added discipline to the firm's management. The costs are in terms of the risk that a company actually ends up defaulting. The risk that there is an agency problem, and we'll discuss about this in more detail as we go along, and the loss of future borrowing capacity for a firm, right? So let's take them one by one. Let's look at the key benefits first and understand that. Now, cost of debt is lesser than cost of equity, right? That's because the debt holders have a priority in terms of getting payments. So we have seen we calculate cost of equity using the CAPM, which is risk-free rate plus beta into RM minus RF. Usually, because RF is close to about 5% as per our calculations and RM minus RF is about 8%, unless a firm is very, very safe, the beta would be north of or higher than 0.7, 0.8. So this number beta is going to be anything, for most firms, the beta number is going to be greater than equal to 0.7. In which case you are looking at a number of close to about 10 to 11% at least as cost of equity, right? Cost of debt for most firms, given that risk-free rate in India is about 5 to 7, Government of India borrows at 7%, going to be approximately anywhere between 8 to 12% depending on what kind of companies are there, right? And obviously the company where the cost of debt is 12%, the cost of equity will be significantly higher because the beta of these companies would be 1.5 or more. So for all practical purposes, we know that cost of debt is less than cost of equity at all points, right? If that is the case, then it makes sense to have debt on the books because debt is cheaper. Equity is not cheap, right? So you could enhance the return of the equity holders, enhance ROE by taking debt, right? Or some debt, right? We can also go back a bit and try and gauge this. Recall our DuPont analysis. We said return on equity is nothing but net profit by equity, which can then be written as net profit by sales into sales by assets into assets by equity, right? This is the profitability ratio, net profit margin. This is the sales turnover, asset turnover ratio. And this third number is assets upon equity. The third number is going to be assets upon equity. Assets are nothing but effectively equity plus debt upon equity. So that's 1 plus debt upon equity. So if a firm increases the debt equity ratio, typically return on equity mathematically goes up, right? So if you have zero debt and you take a little bit of debt, that would usually result in enhancing return on equity, right? Because if you, let's say, had 100 crore that you returned to shareholders, returned to equity guys, and borrowed 100 crore, right? On this 100 to the equity guys, you would have been paying at least 12%. So that would have been 12. On this borrowed 100, you'll probably be paying 8%. So that will be 8 crore. So you'll save this 4 crore by this transition, right? So thereby debt benefits come in. The second benefit that comes because of debt is on account of lower taxes. The interest that a firm pays on debt reduces the pre-tax profits. This interest is tax